Today, business activity indexes were published in several leading economies of the world: China, Japan, and the United States. Even more important report for the monetary policy regulator was released in the Eurozone. The market got to know the dynamic of a consumer inflation last month. In addition, world markets reacted to the situation in Taiwan that suffered the strongest earthquake in the last 25 years. As a result of this negative news, stocks in China, Hong Kong, and Australia sank the most. Investors have been monitoring the Chinese economy, which is under pressure from a high debt burden and trade disputes in the world. As the country is the world's largest buyer of commodities, the contraction or growth of its production largely determines the outlook for commodity and fuel prices as well. As data released today showed that China's economy has moved towards recovery, even despite the real estate crisis and the geopolitical tensions. The overall composite index of business activity in China rose to 52.7. Thus, its March figure not only exceeded the previous mark of 52.5 points, but also logged the fifth month of growth. Beijing does not give up efforts to improve relations with its largest trading partner. Perhaps the telephone conversation held today by the US President Joe Biden and China's leader Xi Jinping will turn the situation in Beijing's favor. Meanwhile, Washington is now considering a final decision on the revision tariffs on China. The state of affairs on the U.S. economy is generally not bad. Factory orders are growing, manufacturing is gaining momentum, and strong demand for workforce is keeping the labor market buoyant. However, business activity indicators published a few hours ago are lower than expected. For example, the indicator in the services sector fell to 51.4, while the forecast expected it at 52.7 points. At the same time, the composite PMI, which include both the services and manufacturing sectors, remained relatively stable at 52.1 points. Its March reading was slightly lower than the preliminary estimate of 52.2 and February's 8-month low of 52.5 points. Nevertheless, this figure still indicates a confident increase in business activity in the United States. Strong economic data and a rally in the commodity market were a disappointment for those traders who expected a quick cut in the U.S. interest rates. On the whole, Wall Street has rallied by almost 30% from its October lows in anticipation of a monetary easing by the Fed Reserve. At the present, the benchmark stock indexes have gone back, and they slide yesterday turned out to be the largest since the beginning of March. The S&P 500 suffered its worst day in nearly a month, losing more than 0.7%. On Wednesday, its price intraday corridor remained in the red zone between 5,184 and 5,208 points. The US dollar conquered 20-week highs at 105.10 earlier this week, and today its index against the 6 major currencies has adjusted to around 104.70. However, this pullback appears to be more technical than driven by fundamental factors. Besides, the markets took a break before the speeches over several policymakers of the Fed Reserve. And today, during the New York session, the Federal Reserve Chairman said and other policymakers will make public remarks. However, Jerome Powell is unlikely to predict a quick change in monetary policy and transition to lower interest rates. On the contrary, most likely markets will hear approximately the same ideas expressed this week by the San Francisco Federal Reserve Bank President Mary Daly and her colleague from Cleveland, Loretta Mester. They said that they still expect 3 rate cuts in 2024, and the bigger risk is to start cutting too early. Previously, most economists expected that interest rates in the Eurozone and the United States would begin to decline at approximately the same time. Now, these prospects are increasingly divergent. While the Federal Reserve, on the back of a strong economy, has a reason and opportunity to postpone the moment of monetary easing, the ECB, on the contrary, is bringing it closer. The report on consumer prices in the euro area published today has finally confirmed that it would be the ECB that will be the first to begin rate cuts. Preliminary data showed a decline in consumer inflation in March to 2.4% on a year. That's the annual CPI sank to its 28-month low. The core CPI, which excludes food and energy prices, also fell to 2.9%. As we see, prices are getting closer to the target 2% set by the ECB, and the regulator itself is confidently moving toward changes in its monetary policy. For this reason, the Euro-USD pair has been bearish since the second week of March, and today the single currency recovered to the 1.0770 mark and even signaled a further rebound within the intraday range of 1.0767 to 1.0791. However, it's still difficult to determine whether this movement is a correction or reversal of the overall bearish trend. Technical indicators could have reached oversold values on the intraday charts and gave the signal for a correction. If it drags on, the euro will try to recover to 1.08. As for the possible weakening of the euro, this scenario will become relevant if the support line of 1.0750 is breached. While the wait-and-see market sentiment puts pressure on the US dollar, oil prices are rising higher. The bulls have already brought the Brent price to its highest level since October last year, around $89. In addition, crude oil extends its rise due to alarming geopolitics. The oil market is in suspension because of a meeting of the OPEC and its allies is due to take place today. Data on the US oil inventories will be also available later today, but it seems that the cartel of oil exporting countries is unlikely to make any changes in its production policy now. All in all, the benchmark Brent seems to be firmly settled in the bullish zone today, holding gains within the daily range of 88.7 to 89.9. The critical level of 90 now acts as a resistance and quite achievable. After all, apparently, oil prices will continue to rise step by step. The existing risks, including problems with some oil refineries in Russia, will hardly go away. So you have watched the market review by InstaForex analyst for Wednesday, April 3. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave comments, so see you online tomorrow.